So good evening, everyone, and thanks so much for joining us for our live training this Wednesday evening. I've had a number of questions and comments through the support team here at Trading Mastery over the course of the last few weeks about CFDs, physical stock. We're obviously trading currencies here at Trading Mastery, and also right now, particularly in 2020, we are buying stock, and many of our investors are using CFDs, and many of our investors are using or buying the physical stock. And we also have many new investors here at Trading Mastery that are not quite sure what CFDs are and what physical stock is. What is the significant difference between the two? So tonight, between 7:30 and 8:15, I'm going to walk you through the specific difference between CFDs and buying physical stock, some of the benefits, some of the pitfalls, and then you will have a well-informed understanding of whether or not you want to buy the physical stock or whether you want to use the CFD. It is entirely up to you. I can't provide you specific personal instruction to say this is what you should do, but I can share with you the benefits and the pitfalls, as I said, and you can make up your own mind either way. There are fantastic benefits in both, but it comes down to the individual circumstances to whether or not it's right for you to use the physical stock option or the actual CFD option. So we'll do that first up this evening. Then we're going to have a rapid fire Q&A for about 15 minutes because you will have some questions following our CFD physical stock presentation. And of course, you can ask me anything else you'd like to ask me in that 15-minute rapid fire Q&A. And from 8:30 to 9 o'clock tonight, we'll go through as we do each week. We spend a little bit of time on making sure we are up to speed on the wave count. We touch base with where we are with the major trends in stock and currency markets and index markets, look at the correlations to make sure we remain really, really consistent with everything that we're doing here at Trading Mastery. Now, it's really important that you understand that in the Knowledge Center, in the daily reports, in the live training, and everything that I do with you here at Trading Mastery is going to be consistent. I'm not going to deviate. I'm not going to try and introduce other things because I know firsthand, working with over 4,000 retail mum and dad traders for the last 12 years, that it doesn't help you make money by introducing more stuff to learn, different strategies. The bottom line foundation of the way we look at the market technically and fundamentally is going to be adequate for every person here at Trading Mastery to build a great profit-making opportunity for themselves. So we're going to keep it very consistent. Okay, so let's get stuck into things because we're going to be talking first up before we get into the CFD component of tonight. We're going to talk about what is buying physical stock all about. Now, when I say physical stock, I'm talking about buying shares and stocks the traditional way of owning the actual stock. And I'm going to use an example here tonight of ANZ. And when we get to the conclusion of the PowerPoint presentation here, I'm going to actually take you into the live market and I want to show you a spreadsheet that I keep for myself. And I'm more than happy to supply that spreadsheet to everyone tomorrow in the daily report. And you can update it and keep your own spreadsheet in the way that you would like to do it as well. But I'm going to use the example first of buying ANZ and buying the physical stock, the traditional way that people buy and sell in and out of the stock market. So the share price today was trading at about $15.40, thereabouts, give a few cents here and there. So let's use the example of you'd like to buy some ANZ shares. You'd like to buy a little piece of ANZ. And you've decided that you'd like to buy a couple of hundred shares. So to buy those couple of hundred shares, that means that if we look at the share price, $15.40, times the number of shares that we want to buy. That brings us to a grand total of $3,080. So if I add on the brokerage, now I appreciate with some brokers it might be as low as $10, other brokers it might be $20, so I just pick 15 as an example. But most traditional stock brokers, online stock brokers, whether it be CommSec, whether it be Saxo, whether it be ANZ, Westpac, whatever it might be, you're going to pay roughly between 10 and 20 bucks for any shares up to about $10,000. So up to about $10,000, they generally have a flat fee of anywhere between $10 and $20. So $15. So the total amount needed for your transaction to buy 200 ANZ shares is $3,095. So with respect to this type of physical stock, buying the shares, ANZ pays an average over the last 5 years, an average dividend of 6.15%. Now, I don't buy shares because of the dividend. I must be really clear with that. I don't buy stock just because it pays a dividend. But this is just a bonus, okay? But we need to understand that we do get paid dividends from some stocks and some stocks we don't. For example, if you were to buy the physical stock of Afterpay, one of the best performing tech stocks in the Australian market right now, it doesn't pay a dividend. If you were to buy the physical stock of Berkshire Hathaway, Warren Buffett's business, it never has paid a dividend, and he claims he will never pay a dividend. But some stocks do pay a dividend, and if you own the physical stock, and they do, you will get the dividend, 6.15% on the value of your shares that you have. You also, when you buy the physical stock, you actually receive franking credits or imputation credits. This is so as you can potentially reduce the income tax that you pay, or the tax that you pay on the dividends, because the company ANZ will pay tax on the profits, and you don't want to be paying tax twice. So there's a way in which that you can minimize the tax you pay on the dividends, getting those franking credits. But again, I don't buy stock, and I don't invest in the share market for dividends. It's a nice bonus when it does come. So you now own a tiny portion of ANZ Bank. You've spent a little over $3,000. Your cash outlay was just under 3,100, and you own a little piece of ANZ. Now, if you want to do that and you buy the physical stock, you're going to need to have an online broker that you can buy that physical stock through. I'll talk more about that in a few minutes. But now I want to touch on, and I want to talk about buying stock using CFDs, which is called contract for difference. Now, in many cases, it is very similar. It's very, very similar. But there are some really important, significant differences as well that we must understand and we must respect, because it can be very enticing to use CFDs in times like right now, or in the case of you haven't got a very large bank account, cash that you can use. The attraction of CFDs is that I have leverage, which I'm going to explain for you now. So I'm going to use the same example of ANZ. So it's exactly the same transaction. So we're not going to make anything more complicated. It's the same transaction. And the share price is still $15.40. And therefore, we'd like to buy some ANZ shares, and we want to buy 200. So the same transaction that we had when we were buying the physical stock, we're wanting to do that with our CFD platform. So $15.40 times 200 shares, the same amount, $3,080. But the CFD broker, in the case of Markets X or Markets.com or any other CFD broker offers you 10-to-1 leverage. Now, many years ago, the leverage being offered by CFD brokers was significantly greater than 10-to-1. And in fact, you might be able to find some CFD brokers that still offer a lot more than 10-to-1. But what this simply means is that I only need to put down 10% of the $3,080 to take the trade. I'm going to borrow that money, the difference between the 10%, which is in fact $308. I'm going to borrow the $2,772 from the broker. He's going to lend me that money. And I'm going to pay interest on that $2,772 at 0.0125% per day. And I'm going to show you in a moment, when I finish the PowerPoint here, inside a CFD platform where you see this information, how much money you are required to have to place a position, and what interest you pay, and what leverage is offered. So you can see straight away the attraction, because I don't need to have $3,080. I only need to have 1/10 of it. But the downside is I'm going to pay a little bit of interest every day when I hold that position. So I'm going to show you here what it looks like on the platform. Again, we're still here in our PowerPoint presentation. And you can see here I've taken this snapshot of ANZ earlier today from the MarketsX platform. And you can see there in the middle of the screen, under where it says limit, it says 200. And you can see next to the yellow arrow, you can see the value of the transaction is 3,083. So that was what it was at the time this afternoon. But underneath that 3,083, that is telling me the margin required, the margin of money required to take the position is only $314.40. So rather than have to stump up $3,083, I only need to have a significant smaller amount than that. Now I'm going to explain for you, and hopefully it'll be very clear, the benefits and the pitfalls of this opportunity. Because if you use it wisely, it can work incredibly well for you. But if you don't use it wisely, it can be your investor's worst nightmare. So let's continue on here. ANZ Bank pays a dividend, 6.15%. Now, when you have some CFD shares with ANZ, you do receive the dividend, but it comes as a credit into your account after the dividend is paid. Okay, so in the share market, when dividends are happening, what happens is we have an ex-dividend date, which means the company says, okay, this is how much we're going to be paying. And there's a date following that, usually 2 or 3 weeks later, can be a month later, where they actually pay. And in the case of a CFD, it's a credit into your account. So you get paid for the dividend. But you don't receive the franking credits because you didn't own the shares. The broker did. Okay, remember, they're lending you the money. So they actually own the shares. But you do get the dividend. And you do not own a portion of ANZ. You are just simply trading the price of ANZ. Now, for me personally, if I'm using CFDs, and I've used them previously and I'm using them now, as well as physical stocks, so I use both, I couldn't care less when I'm trading CFDs, whether I get the franking credits or whether or not I own a portion of the business. I'm wanting to use the opportunity of the leverage correctly to be able to invest in stock that I want to own. So your cash outlay was $308 rather than $3,095. Now that can be very attractive because if you've only got a small account of $3, $4, $5, up to maybe $10,000, $20,000, then you obviously can own quite a handsome number of companies and shares. But that's where it becomes challenging to make sure you don't over leverage yourself and get too greedy in the financial markets. But again, remember, we might be controlling $3,000 worth of shares and getting the benefit of that. But we're also going to have to pay the interest on the $2,772 that we've borrowed from the broker on the position. Okay? Works out to be about 4.4% annually over a year. Dividends can pay some of the interest costs, obviously. So there's a bonus that you get there if the company does pay a dividend. So what does this all mean? Should we use CFDs? Should you buy the physical stock? I'm going to share with you a couple of options. And I'm going to show you the way I'm using a $20,000 account. And it might help you decide on what you want to do and how you want to attack it this year. So a $5,000 account. Let's just assume someone had a $5,000 account. With 10-to-1 leverage, that means that you could buy $50,000 worth of stock. So just with a $5,000 account, if you were buying a handful of shares across different industries in the US, Australia, wherever it might be, you could buy $50,000 worth of stock. But the leverage is a disaster waiting to happen for newbie investors. Because you may have seen on the news and in the paper, there was an article in the Sydney Morning Herald that one of the directors here at Trading Mastery sent me a couple of days ago that showed that there's a flood of people coming into the financial markets and they're opening CFD accounts, and even with 10-to-1 leverage, they're funding accounts with $10,000, $20,000, and they're buying $100,000, $150,000, $200,000 worth of stock because the market crashed and it's coming back and I don't want to miss out on the opportunity. These are people that will get burnt. And this is where CFDs sometimes can get a bad name because people don't use the leverage properly. I want you to consider the opportunity. I mean, you can use a CFD broker and use the whole leverage if you wanted to. But in my view, consider using just 2-to-1. Because if you use 2-to-1 leverage at best, you're not likely going to find yourself in a curly situation where you've got yourself overexposed, which I'm going to show you an example in a moment, and have a margin call where you have to top up your account because you haven't got enough money in there to cover the downfall of what's happened in the market, right? Look at the opportunity to use the leverage, consider it wisely, but in my opinion, consider using 2-to-1 at best. So meaning your account might have $5,000 and you purchase up to and not beyond $10,000 worth of stock. I hope that makes sense because I want to give you an example of what might happen if you don't. So your account's $5,000 and let's use the example of you use the whole 10-to-1, right? So you bought $50,000 worth of that ANZ example we gave earlier. Share price was $15.43 into 50,000 gives you 3,240 shares in ANZ. Pretty attractive to someone who's never invested before, and they put 5 grand in their account, which is all they've got, and all of a sudden they're controlling $50,000 worth of shares. But what about if the price of ANZ drops from $15.43 down to $13.90? A fall of only 10%, not very much. Remember, the market fell just recently 34%. Now, that was a market crash, the fastest, deepest market crash ever. But when you're investing, guys, you have to invest for the worst case scenario. What is the worst case scenario? Now, if the share price only fell 10% and you were using all of the leverage, here's the scenario. The shares are valued at $13.90. You've got 3,240 of them. The value of the investment now is not 50,000 where you started a few days ago or a week or two ago or maybe a month ago. It's now 45,036. Now remember how much money you put in your account. You didn't put 50 grand in, you put 5. So therefore, your account would have a balance of $36. Your entire $5,000 effectively would be wiped out, and the broker would close your position if this was the scenario, because they're not going to allow you to go below. So what I encourage you is to consider this. If your account was 5,000 and you used the example of what I said to potentially consider. Now, I'm not giving you specific personal advice here. I'm just sharing with you a couple of examples because this is very important to understand. If you use the 2-to-1 leverage, that means that our ANZ example, 10,000 worth of stock at $15.43 gives you 648 shares. What happens if the price of ANZ drops by 10%? Down to $13.90, exactly the same example as I just showed a moment ago. Here's the scenario. $13.90 times 648, your investment is now 9,007. So $10,000 minus 9,007 equals a $992.80 open loss. So you're down, if the share price dropped 10%, you'd be down close to $1,000. But your account had 5 grand in it. Your account is now only at 4,007 and not the $36 that I showed you a moment ago. So it's very important that we understand that leverage can be our friend when we use it wisely, but it can be an absolute disaster for many people who don't use it wisely. I'm going to show you an example of what I'm doing with this $20,000 account, and you can make up your own mind which way you want to go. So again, example only and not a personal recommendation, but if you had a $5,000 account, you might, if you wanted to use CFDs, maybe you're someone who just said, no, I just want to buy the physical stock. I've got, 30, 40, 50, 100,000, 200,000, or even 10,000. I'd just like to invest some physical stock. That's perfectly okay. Absolutely fine. And I'll share with you what you'll need to do that. $10,000 of cash, if you wanted to use CFDs at 2-to-1 leverage, means you could control $20,000 worth, and so on and so on. Just be very, very mindful of what this actually means to your account if you over leverage. So what I'd like to do now is bring up on the screen. I'd like to bring up on the screen for a moment the actual platform. Actually, before I do that, I'd like to show you something else. I'd like to show you a spreadsheet. And I'm happy to put this spreadsheet into the daily report tomorrow. Okay, because this is the spreadsheet that is following the stocks in this particular CFD account. Now you can see here that, I'll just give an example. Down the bottom here, Aussie portfolio, US portfolio. I have not bought stock using CFD for the European portfolio, just the Aussie and US. And you can see all the stocks down through column B, the date by which they were purchased, the price, the number of shares, the initial investment in terms of what the total investment would have cost, the current price, the gain or loss, the total investment, the profit or loss, and also I want to know when it goes ex-dividend as well. So I'll give you this to you tomorrow in the report. But what I want to show you here is if I scroll down here where it says column E, and if I scroll down here, if I was to buy all of the stock in this Aussie portfolio, the number of shares that I've got in column D, I would need $9,443. And that's okay. And if I then have the US portfolio, of which you can see here, if I scroll up to the top, it's exactly the same. It has the date, the shares that have purchased, the investment. If I scroll down here, if I just used physical stock, bought physical stock, 14,000 US dollars converted at 65 cents on average means that I would need 21,000 Aussie dollars plus the 9,000 from the Aussie portfolio mean that I would need $31,000 to buy the physical stock of what I've just showed you there in the US and Aussie portfolio. Okay, so I would need 31,000. Now I'm going to show you the CFD account here to share with you something that is important for everyone to understand. I need to actually get the Q&A box up because I'm not sure whether or not this displays correctly. Can someone tell me in the Q&A that you can actually see this funds management box? Can you see the funds management box, guys? Yes or no? Yes. Okay, great. Okay, now you can see here the balance is 20,099. Okay, that's the balance of the account. The equity, if I took the small loss across all of those stocks at the moment of $77 off that total there, it would give me this total right here. Okay. But the important one here is this one here, the margin used. Okay. Now, I just said a moment ago that if I wanted to buy all of the stock using cash and own the physical stock, I would need $31,000. In this platform, I've only had to put up 3,144 used margin. Now, if I actually put my cursor on each one of these little question marks, it's going to tell me. I'll read you this. 637%. It's actually very important. Indicates how close your account is to a margin call, calculated as equity, money, initial margin, and shown in percentage. When margin level drops below 100%, you will not be able to open new positions. And if it drops below 50%, all your positions will be closed and working orders will be cancelled. Now, I plan to, with this account, potentially buy up to $50,000 worth of stock. That would mean, tell me, so as I actually know you guys are understanding, if I was to buy up to, I've got $20,000 in this account. If I was to buy up to $50,000 worth of stock, I would be using a little bit more than 2-to-1 leverage. And if that was the case, what would this used margin be? What would it say right here, approximately? Tell me in the Q&A, just answer in your own box, what would that say there? It wouldn't say 3,104, it would say what? Exactly, it would say 5,000. And I would still be a long way away from any danger. Okay? Now, if I come over here and I click on positions, and I come up to the top here, you should be able to see here, it says Essentia. Bought 2 shares at 175.42. Now, ordinarily, if I bought the physical stock, I would need to come up with 2 times 175. But I only needed to come up with $54. This total here, 3,144, if I went through and added up every one of these used margin, used margin, used margin, used margin, used margin, used margin, it would total this figure right here. Okay? Now, if I want to see what interest I'm going to pay overnight on the stock that I'm buying, I can just simply click on Key Statistics right here next to chart, scroll down, and I can see that I'm being offered 10-to-1 leverage with a 10% margin, and the overnight interest is 0.0076. Okay? Now, if you want to work out what you would annually pay for that, times it by 356 days. And it will tell you the amount of shares that you decide to buy using leverage, what interest you would pay over a year. Now, just tell me in the Q&A, guys, tell me in the Q&A to whether or not tonight I have been able to share with you enough for most of you to understand the difference between physical stock and CFDs. Okay, does that now help those of you that are not really familiar with CFDs? Does that now help you? Because it's really important, right? Because what we need to make a decision on now, we need to make a decision on, are you going to buy stock using CFDs, or are you going to buy physical stock? Now, this MarketsX platform does not give me the ability to buy physical stock. The MarketsX platform gives me the ability to trade currencies, which I need to be able to do. And it gives me the ability to buy any stock I like around the world using a CFD option. If I want to buy the physical stock, I need to have a physical online broker account to do that. Now, you can, if you would like to do that, you can do it very quickly and easily through CommSec. You can do it very quickly and easily through someone like Saxo Capital Markets in Sydney. Our family has an account there. There are lots and lots of online brokers that you can buy the physical stock with, and it's very, very simple and straightforward to do that.